I don't want to spend all this time looking for the outperformer, taking the risk. I would just buy Bitcoin and
go into Bitcoin
do nothing. You could probably buy Bitcoin and ETH and do nothing for the rest of your life, and you'll be absolutely fine. But there's a game to be played, which is we want to create more money for ourselves. We didn't have it at $3 and hold it till this very day and do a massive size bet. So, for everybody, we want to make some money. We want to, as everybody on crypto Twitter says, retire your bloodline.
Raoul Pal presents the idea of a market supercycle, projecting a revolutionary stage for digital assets in 2024 that will be fueled by a special combination of circumstances. He characterizes this time as one in which asset prices rise above expectations, market euphoria reaches a fever pitch, and liquidity soars. Although there have been localized spikes in a number of cryptocurrencies in the present market environment, Pal stresses that this is just the start of a larger wave of opportunities. Liquidity is at the core of his analysis and serves as a crucial lens through which to view market movements. He emphasizes how global monetary policy, particularly fiscal dynamics and Federal Reserve actions, shapes asset values. Corrections are normal when liquidity circumstances tighten, and Pal believes that Bitcoin may decline from $120,000 to $100,000 before rising again. He contends that these corrections are a natural part of the market's rhythm and need to be viewed as opportunities rather than failures. Make sure to like this video, subscribe to the channel, and turn on post notifications for more insights like this. Thank you for watching and enjoy the video.
That's always the first phase of it, don't forget. I mean, if you go back to 2020, it was not until like November that ETH started really performing. It was all Bitcoin dominance. And Bitcoin dominance topped almost at the right moment. Bitcoin took off. Now we haven't got to, I think my next phraseology is going to be the banana singularity. That's when everything goes bananas. But what we're seeing is this is a tricky market like this, because what you're getting is a whack-a-mole, which is never the thing that you're owning.
It's a bull market for everybody but me.
It's what your friend owns, not what you own. And then you get like a week in the sun where everything goes up and then it goes off again. So we're not at the banana zone singularity point yet. That will come as well. That's probably, sometime Feb, March, when it all gets silly. What a time to be alive. I mean, yes, look, there is an enormous amount of speculative risk taking, but this is, and I've said this for a very long time now, is the greatest macro opportunity of all time. Yes, you can be ultra safe and just own Bitcoin and you'll do very well indeed. Or you can try and figure out how to make more money, because really, you got a tailwind. Everything goes up. When the music stops, a lot of this stuff goes to zero, but I don't blame people for playing the game. And the game of the biggest mid stuff, okay, that's a very big game indeed. The when Ethereum started, or Solana, or Sui, or Apps, or whatever it is, right? These things are incredible wealth generating machines. Look, there's always something to worry about, but generally speaking, let's look at the last Trump administration. So from September to the end of the year, the dollar rallied. September, the end of the year, rates went up. Same narrative. It was all about tariffs and, what's he going to do and how's it going to play out? Almost exactly as the year turned, the dollar went lower and rates went lower. So I've been producing a chart showing that global liquidity tightened and it has a 10-week lead time. And that should mean that at the end of the year, we get a correction. Now, that would not be surprising. Let's say Bitcoin gets to 120, it corrects back down to 100. I mean, that's just normal course of business. But Twitter being Twitter is losing its mind over this correction. I get messages, is this the one? I'm like, calm down. You should be expecting at least another 4 or 5 of these over the course of the next year. They're just regular. But for some reason, that people are losing their minds. But once that's out of the way, usually it should be good. Now, liquidity needs to come back. So we need to see the dollar weaken. We need to see rates come down somewhat. Those are key things for us. I don't see any reason why not. And then there's a bunch of technical stuff like the draining of the Treasury General account over the period for the budget negotiations and stuff like that. And normally that's a big injection of liquidity. And the Fed are doing other rinky-dink stuff, like they're going to cut interest rates on the reverse repo, which basically is trying to force money out of money market funds and into the private sector. They've got to roll the debt, and they can't at high levels because it just means the compounding of debt. And if Elon is serious about trying to get the payments down, well, debt's the biggest one. It's now bigger than the military. So they've got to do that. The other side of the equation is we all know China's in trouble right now. Its economy's a mess. Bond yields keep falling. And really why China's in a problem is it can't stimulate without losing its currency, and it doesn't want to do that. So what it needs desperately is the US to inject liquidity so it too can inject liquidity. It needs a weaker dollar. Everybody needs a weaker dollar. Now, last time Trump got in, one of the first things he said is, we want a weaker dollar. If you think about what they want to do, they want to export US goods. They want a weaker dollar. They just want a weaker dollar. And they're going to have to do that. Is people are like, the institutions are coming and corporations are coming and governments are coming. Well, for this asset to get from 2 trillion to 10 trillion, you need a ton of money. It kind of has to have adoption by major people at this stage, because there's no way retail can drive Bitcoin from 2 trillion to 10 trillion. So it is the adoption wave. We were just lucky because this is the first asset known to humanity where retail were first.
Raoul Pal draws attention to the structural inefficiency in the cryptocurrency industry, which is a significant problem. There are frequently enough secondary purchasers or expert capital to keep prices stable when venture capitalists cash out their investments. Retail investors who frequently buy into the excitement at inflated prices suffer large losses as a result of these precipitous price reductions. Pal highlights the need for additional institutional capital to enter the market through professional trading firms and hedge funds in order to address this. He thinks that everyone in the ecosystem would eventually gain from this, since it would lessen volatility, make the environment more stable, and promote more participation from traditional financial firms. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Now, let's get back and hear what Raoul Pal has to say.
Virtually nobody actually owns Bitcoin. People have some, their savings, but what they actually own is everything else. Because nowadays, if Bitcoin goes from 100,000 to 250,000, we're all like, oh, find me a better asset. I'm like, I mean, for normal people, that is the greatest asset of all time.
That is not.
I don't want to spend all this time looking for the outperformer, taking the risk. I would just buy Bitcoin and
go into Bitcoin
do nothing. You could probably buy Bitcoin and ETH and do nothing for the rest of your life, and you'll be absolutely fine. But there's a game to be played, which is we want to create more money for ourselves. We didn't have it at $3 and hold it till this very day and do a massive size bet. So, for everybody, we want to make some money. We want to, as everybody on crypto Twitter says, retire your bloodline. Capital formation at the core is very important, and I think they understand it. But there has to be some guidelines around capital formation or everybody scams everybody.
Right.
And we've seen that, right? If you give them a pump.fun casino, they will scam each other until they all run out of money. So yes, I think we're going to completely overhaul capital formation. And that can be for traditional assets being tokenized. Don't forget, when you speak to people like BlackRock or Blackstone, even more importantly, they own all this real estate. What they want to do is they want to get individuals to invest in their funds to keep their big funds going. And so they want to tokenize. I heard Steve Schwartzman talking about this. I was at some event speaking, and he was, they all want to tokenize their assets. On the other side, tokens have been very profitable for VC funds, but also it's a good way to bootstrap a business as well. So yeah, I think crypto is going to go through some changes, but the big change is the finance system has nothing in its way for adopting the technology now. They're not scared of anybody. So we're going to see a lot of innovation being built in finance now. And don't forget, Goldman, JP Morgan, they've been working on this for a decade. Goldman's crypto team's been around since 2015, I think. So we're going to see that innovation. The other side is all of the brands, the cultural side of stuff, from football teams to pop stars to sporting to everything, entertainment industry, it's all coming. People who needed liquidity gave it to people who had liquidity. That is all that happened at that end of the market. I focused a lot on that end of the market because it's really interesting. But the same happens with punks, and punks have been ripping in price. Apes have been going up because there is some social signifiers, not to necessarily boast, but just to have been around and understand that it kind of says you're part of the club. You have a commonality of interest, something that I'm not sure penguins do, but maybe I'm wrong. So there's an interesting structure to markets is there are more VCs and airdrops than there are secondary professional pools of capital in crypto. Call them hedge funds. It's quite funny because everyone's like, those bad VCs, they get tokens early, they dump them. What's happening with Pengu today? Everyone's taking their cash machine and selling it immediately.
It dumped to crap, huh? I didn't really look, but I saw a lot of red.
I don't know, but they've all done the same. And I've still got shrapnel of my ape coin and all of the that I was like, my MFA coin, you get given this stuff. It's like free money. Isn't it amazing? I've just been given 10 grand. 3 days later, it's worth 12
I heard
seconds.
people who held a Pudgy Penguin at the launch got $85,000 worth of Pengu token.
So anyway, so why there was the big fall is there's not enough secondary buyers because it's retail. The hedge fund industry, which, I've got this asset manager, Xpan, which invests in crypto hedge funds. There's not that many that are of any size. And the total size of that industry is maybe today is maybe $10 billion. The traditional hedge fund industry, $4 trillion. So what happens is the VCs exit, think of that as an IPO, early IPO, and there's not enough asset managers to buy it. So prices fall 80%, 70% before they clear. And then these guys do their homework and say, what do they want to own here? Do I want to own Aptos when it comes out and dumps, or Sui when it comes out and dumps, or Monad when it comes out and dumps? Retail could play that game, but they tend not to because the retail are always the IPO buyers. Oh my God, Pengu's out today, I must buy it. Smash. But I think it's just a structure of markets thing. So I don't think we need retail. I think we need more institutional money into the hedge funds and the professional trading to have professional capital, lower the volatility, and make the space a little more functional.
Raoul Pal presents an intriguing picture of the development of the cryptocurrency market and the structural adjustments required for it to reach maturity. He highlights the significance of capital formation as the cornerstone of market expansion and stability. He cautions that in the absence of appropriate regulations, markets may turn into a pump-and-dump casino where players take advantage of one another until the funds run out. This emphasizes the necessity of managing money within the ecosystem in a more structured and expert manner. According to Raoul, traditional assets will eventually be tokenized, allowing for greater access to investing options. In order to draw in individual investors and maintain their substantial funds, he cites prominent firms like BlackRock and Blackstone that are ready to tokenize real estate and other assets. Conversely, tokens continue to be an effective tool for venture capitalists, acting as a way to both earn substantial returns and kickstart new companies. He adds that established financial giants like JP Morgan and Goldman Sachs have been subtly getting ready for this breakthrough for years, indicating that the financial industry is now prepared to adopt blockchain technology without worrying about being disrupted. This paves the way for revolutionary advancements in the financial sector as well as other sectors such as sports and entertainment, all driven by blockchain's disruptive potential. As we come to a close, his observations serve as a reminder of both the great potential that lies ahead and the growing pains of a revolutionary technology. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.